Hi, Gigi from the RBA. This is our final video in the monetary policy series. In it, we're going to talk about Australia's inflation target. So throughout the series, we've looked at many different aspects of monetary policy. We've discussed the objectives of monetary policy, the tools that the RBA uses to influence interest rates, and how changes in interest rates transmit to economic activity, employment, and inflation. This final video will introduce the inflation targeting framework that the Reserve Bank Board uses to tie together all of these aspects of monetary policy. The inflation target links the outcome of monetary policy to the RBA's objectives. It does this by providing a measurable goal for the Reserve Bank Board to meet when it sets monetary policy. We will discuss what the inflation target is, why the RBA targets inflation, and how the inflation target guides the monetary policy decisions of the Reserve Bank Board. But first, what is inflation? Inflation refers to an increase in the general level of prices over time. The specific measure of inflation that the RBA targets is the percentage change in the Consumer Price Index, or CPI. The CPI measures the cost of a basket of goods and services that Australians spend money on, things like food, clothing, entertainment, transport, childcare, health, and some types of housing like rent and new home building. To learn more about consumer price inflation, my colleague Stefano has some videos on the topic. Australia's inflation target is to keep the annual increase in consumer prices between 2 to 3% on average over time. The RBA has chosen to target a 2 to 3% rate of inflation because it is suitably low and can help the RBA keep prices relatively stable over time. We'll talk more about this shortly. The inflation target is the framework used by the Reserve Bank Board to guide its decisions on monetary policy and to measure whether it's meeting its objectives. It ensures that the Reserve Bank is accountable to the Australian public in how it uses monetary policy to manage the economy. The on average, over time part of the inflation target is important. It gives the inflation target flexibility. This means that the Reserve Bank Board does not try to always keep inflation between 2 to 3%, as illustrated simply on this chart. This is because inflation can be affected by temporary things, say supply disruptions to certain goods and services, or tax changes. Monetary policy shouldn't respond to these because it cannot affect them. The flexibility of the inflation target also allows the Reserve Bank Board to manage trade-offs between its objectives over short-term periods and to consider some of its broader objectives when setting monetary policy, such as financial stability. We discussed this more in our video on the objectives of monetary policy. So although inflation can move around and is sometimes outside of the target range, over the medium term, the board wants inflation between 2 to 3% per year. So that's what the inflation target is. Why does Australia have one? In a previous video, we discussed that the RBA has 3 objectives: the stability of the currency, interpreted as low and stable inflation, full employment, and the welfare and prosperity of the Australian people. The inflation target summarizes whether the RBA is meeting these objectives, which are all linked. So why do we choose to target inflation? Well, if prices rise by too much or too quickly, such that inflation is too high, it's very harmful for an economy. For example, if the prices of goods and services rise faster than people's incomes, then they'll be able to afford fewer goods and services than before. In extreme instances, this can lead to people abandoning productive activities to make sure they can buy basic goods and services before prices rise too much. The opposite is also true, where falls in prices, called deflation, can also harm the economy. If prices are falling, people might delay purchases until prices are lower. This could cause businesses to lay off staff, reduce wages, or even go out of business. Deflation can also make it more difficult to repay debts, because even as incomes fall, the repayments on debt do not change. It's also important for inflation to be relatively stable over time. That is, the rate of inflation is neither speeding up nor slowing down too much or too quickly. If inflation is unstable, such that it moves around a lot, households and businesses will find it very difficult to make decisions about prices, wages, and spending today. This is because they're very uncertain about the future rate of inflation and how this might affect the decisions they need to make. You can read more about the costs of too much or too little inflation in our explainer on Australia's inflation target. The RBA adopted the inflation target in the early 1990s, as did various other central banks around the world. Many more central banks followed suit over the coming decade, so many economies now use inflation targeting to guide monetary policy. Targeting inflation of 2 to 3% is how the RBA has defined low and stable inflation for the Australian economy. It's sufficiently low that inflation doesn't significantly influence people's economic decisions, and it avoids many of the costs of inflation that is too high or too low. It's also consistent with economic conditions that can help keep inflation relatively stable. Other countries have chosen slightly different inflation targets, and that's okay. For example, in New Zealand, the inflation target is between 1 and 3%. So how does the inflation target work? That is, how does it guide the decisions of the Reserve Bank Board when it sets monetary policy? Assessing the actual and expected rate of inflation and a range of other economic indicators helps the Reserve Bank Board to make decisions about monetary policy. These decisions involve the board using its monetary policy tools to stimulate or dampen economic activity, and thus influence employment and wages growth and ultimately inflation. Over the past 30 years or so, the board mainly used the target for the cash rate as the primary tool of monetary policy. However, as we've discussed, with the current target for the cash rate set at such a low level, the board has also turned to other tools. One way we can show how the RBA influences inflation is through this chart. On the x-axis is time, and on the y-axis is economic activity, which we measure using gross domestic product, or GDP. The wavy line shows how actual economic activity tends to change over time. Changes in economic activity are called economic growth. The economy is often observed to grow in a cyclical pattern over the medium term. So economists often refer to changes in economic activity over this length of time as the business cycle. The straight line is what we call potential economic activity. This measures how economists think the economy could perform if all resources, labour and capital, are used at their normal levels. When the economy has grown in line with its potential, employment and inflation have historically been consistent with the RBA's objectives. If inflation is above the RBA's target, this often occurs in an economy that is growing faster than its potential. In other words, the economy is running above full capacity. Demand for goods and services may outstrip the available supply, which will put upward pressure on prices. The unemployment rate will fall below its natural level, meaning the demand for workers begins to exceed the available supply. In response, wages growth begins to accelerate. Higher wages growth then puts further upward pressure on inflation. In this situation, the Reserve Bank Board will wish to increase the cash rate target to dampen economic activity and bring inflation back into its target range. This works through the transmission channels we have discussed in previous videos. On the other hand, if inflation is below the target, then this is typically associated with higher unemployment and weaker economic growth. Often you will hear this described as the economy having spare capacity. In this instance, the board will typically lower the target for the cash rate to stimulate economic activity and employment through the channels we've discussed and move inflation higher towards the target. If the target for the cash rate reaches its lowest practical level, then the board can also use some of its other monetary policy tools to lower interest rates and stimulate economic activity, employment, and inflation further. We've discussed these in previous videos and seen them in use in Australia in recent times. So that's how the RBA uses monetary policy to influence the business cycle. Another way you could think about this is that the RBA conducts monetary policy to bring that wavy line as close as possible to the straight line. Or, in other words, the RBA wants the actual economy to perform as close as possible to its potential, since this is usually consistent with low and stable inflation, full employment, and promoting the economic prosperity and welfare of Australians. Recall in our previous video, we discussed how it takes time for adjustments in monetary policy to have their full effect on the economy, around 1 to 2 years. Because of this, the board will not only consider the value for inflation and other economic indicators today when they set monetary policy, but also what the RBA forecasts these indicators to be in the future. So now that we're up to speed with the inflation target, let's take a quick look at some data. This chart shows the annual consumer price inflation over a long period of time. This band is the RBA's 2 to 3% target range. You can see that prior to inflation targeting being introduced in the early 1990s, inflation was often high and also very volatile, meaning it moved around a lot. This high and volatile inflation was very costly for the economy and motivated the introduction of the inflation target in the early 1990s. You can see that since the early 1990s, inflation has been a lot lower and more stable. It hasn't always been in the target range, and as we discussed earlier, that's okay. On average over time, inflation has fallen within the target range though. In fact, since the beginning of the inflation targeting period in the early 1990s, inflation has averaged 2.4%, pretty much in the middle of the target range. More recently, inflation has been below the target band and monetary policy has been very expansionary in response. So that's it for this video and our series on monetary policy. Hopefully, if you've watched through the series, you now have a good grasp on what monetary policy is, how it works, and how it affects the economy. See you next time.